to welcome everybody too. I mean, kind of as the old guy.
Yeah, go ahead.
We appreciate you being our kind of like being our guinea pigs, I guess. We're going to do this regardless. Going forward in the future, we're planning on doing this every couple of weeks on a regular scheduled basis. We think we're going to use it at the first and the third Tuesdays. That's our non-radio days. So I think, is that the tentative plan, Paul? That the first and third Tuesdays of the month around this time?
Yeah, I believe so.
I think so too. So we're learning a lot from this crisis, I guess is what we'll call it. I'm going to do my best to keep my views out of it. In fact, I'm going to keep my views out of it. This is going to be purely financial and what should we be doing, what can we be doing, and where's this thing heading. But so we've learned a lot that fortunately, we were up to speed with using Zoom for the last few years. But still, there's some new things with the security that some things had to be ironed out, using the webinar format of Zoom. So some of those things were new to us. But we're kind of, frankly, I think it's safe to say, guys, we're all pretty excited about kind of like old dogs learning new tricks. And we think that it's going to allow us to communicate more frequently with clients. And our hope is that clients, there's a little bit of a learning curve to getting on to a Zoom meeting, and there's little bugs. My wife had one when she first tried to get on for some reason on her MacBook. There was a little glitch, and we worked that out. So those things are going to happen on the front end, but once we get through this learning curve, I envision a day where instead of calling the office, you're just going to say, hey, I'd like to have a Zoom conference with you. And maybe it's a 5-minute conference, but at least we can see the visuals. It's always been my belief after 36 years that what's important about face-to-face meetings and that level of communication, other than we've been doing it for hundreds of millions of years, and it's kind of part of our DNA, is in every meeting, there's always a question that didn't get asked, or there's a question, but I'm always searching for that question under the question. And I've told the boys, sometimes it's just a flinch that you see that kind of promotes another question, like to dig a little deeper. So we're excited about this. And then we hope you're enjoying our Friday news flashes that son Paul is putting out. We're all contributing to that. We're curating. I probably read certainly 2 to 4 hours a day. My wife will attest to that. A pathologist client of mine suggested I should get a part-time job in pathology since I seem to be so interested in the epidemiology of all this. But we curate a lot of, I sweep a lot of great content throughout the week, and we're going to pick the best 1, 2, or 3 articles along with our own in-house work to try to communicate with you more frequently. So sometimes there's always a silver lining to these crises. This is one of them, we hope. And so today's our inaugural event. It was really the younger guys thought of it. I was kind of proud of that, of course, spoken like a true father, as you might imagine. And I like to see the initiative there, and for young people that haven't been in the business for 36 years saying, hey, we got to get in front of our clients. We need to be communicating and providing good content, good ideas. Look, there's stress, especially about a month ago when we were at new lows in the stock market. It can be quite concerning. And I know we have a number of new clients. When I say new clients, I mean people that have come to us maybe in the last year or so. And these can be even more unsettling times. Welcome to retirement. You walk into really something that we've never seen before, at least from a triggering reason. And as far as a market declines, I've seen these over and over and over again. So they don't tend to concern me. So we're going to address a lot of stuff today. Feel free to ask additional questions. And I'll just kind of be quiet now, if that's even possible.
Yeah, on that note, we actually had our first question come in live here in Zoom, not when you guys signed up. And that question is, did recent legislation change RMDs for IRAs?
David, I'm going to let you handle that one. I mean, any of us could, but I know you just wrote about that.
Yeah, this is a pretty quick one, actually. So the answer is yes. So for 2020, you do not have to take required minimum distributions from IRAs or inherited IRAs, which is a nice benefit to people because, we do have some of our clients that really don't need that money for spending. Maybe they're taking it out of a taxable account instead of their IRAs, and that can reduce your taxable income substantially. So short answer is yes. And we've gone through a list of all of our clients who have big required minimum distributions. And we're looking at, hey, are there any tax opportunities that arise because of that? Because sometimes when you're in an abnormally low tax bracket, we look at things like Roth conversions and stuff like that. But that's the gist of it. So for pretty much all of our clients who don't need the money, the recommendation is don't take your required minimum distribution for 2020.
And then one other thing I thought of, and I discussed this with an estate planning attorney about the idea, because we were looking at, for one client, to do a fairly large Roth conversion this year, and maybe for the next several. And it struck me that, you know, this might be an opportunity to double up in a sense. He doesn't need the, you know, the money to spend from a large required minimum distribution. So I suggested that, hey, why don't we kind of double up this year? We'll take what you were going to put in your required minimum distribution into a Roth conversion and the other amount of money we were going to do. So that's one of the things you can rest assured we're looking at every client situation to see if it makes sense to, you know, to not take the required minimum distribution if it's not needed. And then perhaps, and in some cases, we'll suggest a Roth conversion. That's something we're working on right now. We prefer to do that from lower market values. We'll get into that, of our views on how this might play out in a little bit.
Awesome. Well, we actually just had another question come in, and it's a question that came in when somebody else registered too. So it must be something that a lot of people have. Would it be better to look at drawing on Social Security and leave the stock portfolio as it is in order to have a chance to let it rebound?
Well, Dave, I know, again, I'm going to go to Dave here. I won't always do this, but it's just because we literally had a conversation yesterday about this. And we recommended to one couple that we were planning on basically delaying for maybe up to another year. That's when the one spouse will be 70 and the other one is a bit younger and about, should we claim not only his benefit, but the spousal benefit. So Dave, why don't you just briefly address that?
Yeah, I think this is one where you look case by case because it does depend on the specifics of the case, how old you are now, how long you were planning on delaying, what your asset allocation is. The more fixed income you have that you can draw on, the less you necessarily need to worry about, you know, withdrawing while the market's down, because we're withdrawing from fixed income anyways. So for most people, I would say it's not 100% necessary, but it is something that when things get really ugly. So when, you know, we were at towards the bottom in mid to late March, I was looking at this for a few of my plans that were kind of on the borderline of potentially needing an adjustment. And I said, hey, maybe this could be a help. And I test out the plan basically saying, okay, well, almost pretending as if nothing before had happened. If you came in the office today and we looked at what's the best Social Security claiming strategy, kind of look at that, and there's a little bit of judgment call there too. So short answer is it can, but for the vast majority of scenarios, this hasn't been ugly enough to warrant that, just because we do build plans to withstand market declines. We know they're going to happen, and there is still a substantial benefit for delaying Social Security. So as long as we have a good plan for kind of that bridge period in between, you know, your retirement date and when you claim Social Security, it's usually not necessary, but it is something that it's almost like I look at it as a last resort kind of backup thing that can kind of help in those really extreme scenarios. And
it's been my experience sometimes when it's kind of a coin flip whether you do it or not. For some people, it's just simply psychologically, it makes them feel better if they're withdrawing less from their portfolio in a particularly large decline. And, you know, in those cases, then I encourage it. But again, I think, David, I think that's smart let's reserve that for when things get a little bit scarier. We were getting close in, you know, at the latter part of March for sure to consider that, even really look at every plan to make that decision potentially. And it's my belief we'll get a chance to be scared again sometime in the next few months. And so just rest assured, that's one of the arrows in our quiver that we will certainly be quick to suggest if we think that's going to make the plan better.
So I think a kind of related question to that, not exactly the same, not about Social Security, but just about taking withdrawals from your account in general right now. You know, should you maybe delay those, stop them altogether? I think this might be somewhere where we can get into the role of fixed income in people's portfolios.
Yeah, who wants to take a stab at that? You don't want me to do all the talking, sure.
I can take that. That's fine. So I think one of the things that we kind of came to realize during this process is that a lot of our clients assume that their entire investment portfolio is subject to the same up and down market interactions that stocks are experiencing, when that isn't the case, simply because most of our clients have a portion, if not a good portion, of their allocation of stocks and bonds in bonds. So if you have, for example, a 50% stock allocation, that means you have a 50% bond allocation. Half of your money is significantly sheltered from the very volatile up and down movement of the stock market because it's not invested in stocks. And because of that reason, of course, we can pull the distributions or the monthly distributions out of the bond holdings, which again are not fluctuating with much up and down movement at all. And that way we can allow the stock portion to sit still. We're not withdrawing from the stock portion, and allow that stock portion to then rebalance or go back up so it regains its position as it was, and then eventually overcome it over the long term. But the strategy is just very simply, if at all costs, try not to sell from stock holding positions during a down time. And that's the sheer value of holding bonds and not being 100% equity.
Yeah, and I think that's critical. And I've come to the conclusion, and it's probably our fault, that a lot of clients, we haven't really made it clear enough that, look, for most of our clients, there's at least 20, 30, 40, 50% of your money is in investments called bonds, as you said, Ryan, that aren't impacted by any of this stuff. And I think they see the overall portfolio maybe fall 10 or 15 or 20%. And I think that's what leads people. And once I've explained to a few of my clients that, look, you have a $500,000 in short-term high-quality fixed income, or 100, it doesn't matter what, relative to their account, it's substantial. So we won't be selling out of fixed income out of stocks unless we have to, which I don't think we've had to. Not only that, that leads us to, anytime clients leave money, guys, explain how cash flows and rebalancing and all that works a little bit. If one of you would.
You actually kind of anticipate.
Oh, okay.
I'm sorry, go ahead. These two questions that just came in were actually both about rebalancing. Have your efforts changed with all the volatility, or should you even avoid rebalancing until the market recovers?
Who wants to take a stab at that?
Yeah, so I think I'm going to take the second one, because I think that's really kind of almost a follow-up to our discussion here, which is for people who take portfolio withdrawals, the withdrawals we use as a means of rebalancing. So a lot of times what's going to happen, so the market's falling, you're taking withdrawals, we're freeing up cash. By the very nature of rebalancing, we'd want to be selling from the bonds and then basically reinvesting that in stocks. But if we're freeing up cash, we're basically selling the bonds and then sending them cash. But when things happen really, really quickly, we do actually have to do a rebalance still. So for like the last few years up until this big decline, for our clients who were taking withdrawals regularly, I don't think I had to do any just like one-off rebalancing, because I was using those cash flows out of the portfolio to sell anything that was overweight. But in an extreme scenario, we still typically recommend rebalancing. So then I think the question that he had is basically, okay, but if you're 50% stock, we rebalance, the market ticks back up, are you going to sell from fixed income or stocks? I think that's where some discretion comes in, because we do put bands around our targets for stocks. And I think, say we rebalanced, which we did right around, mid-March, mid to late March, the market shoots back up like a rocket. You're still not over that upper threshold. So sometimes we'll use our judgment and say, hey, maybe for this withdrawal or the next couple withdrawals, we'll still sell from the bonds. But we won't ever let that cause your equity allocation to go above our upper threshold. So there will be times technically where you'd sell from stocks, but it would be if the market had recovered quite a bit from where we did the rebalancing, and then we'd be selling potentially from stocks a little bit. But it's probably going to come from a blend at that point too. and you're still going to have a substantial number of years of fixed income. So if it falls further from there, you still have quite a few years of spending in that bond portfolio.
And we rebalance periodically. We try not to overdo it. There's costs associated. We try to minimize everything. So we try to have sensible conclusions. But really, for the last couple of years, whether the clients understand it or not, a lot of times when the stock market's doing well, what we're selling are the parts they like the most, and we're buying back in larger percentages to kind of rebalance even the stock portion of the portfolio and asset classes that really have been underperforming for some time. And that's really the beauty of diversification and putting this on somewhat of autopilot. It's kind of countercultural. Clients don't like to sell their winners and buy the losers. And we're not talking about selling all of them. We're just talking about a portion of them to rebalance. But that's really one of the benefits to rebalancing and having somebody else do it. It's counterintuitive to the individual investor. So the boys have been very active. I think that's important for every one of you to know that we're looking at these accounts every day. We're looking at people's plans every day. I'll ask the boys, how many plans do we have right now that are getting close to maybe needing some sort of modification in spending? And we get together, just so you know, as clients, some of the other things we're doing is we get together throughout the week on scheduled visits on Zoom, so all 5 of us are always on the same page and we're all singing out of the same songbook. That allows me to stay really plugged in, probably more than I usually do on a day-to-day basis, with really the blocking and tackling of what's going on in people's accounts. And speaking of that, and then Paul, I'll let you take over, but I'd be interested, and maybe the clients would too, because at some point here I want to talk about the importance of planning and how we anticipate, not predict, but anticipate these types of declines. But what percent of your clients, guys, each one of the guys works with a set of clients with me as the lead advisor. Has it been pretty infrequent that you've had to make modifications to the plans for, modest spending cuts or anything like that?
I can speak to that. It's been quite small.
And so
yeah, it has been quite small. And I was just going to add in real quick, like people might be wondering, well, what is that threshold when we decide to rebalance? And it's usually 5% above your equity allocation or 5% below your asset allocation. So let's say you have a 60% bond or 60% equity, 40% bond mix. If it went up to 65% equity, then we'd start to look to pare that down. Or if it went below 55% equity, we'd be looking to pare that equity back up to 60%.
And when we say equity, and I'm always trying to teach the guys, it's kind of inside baseball for us, to maybe have 3 or 4 different names for the same thing. When we refer to equity, we're talking about the amount of money you have invested in the broad global stock market, the great companies of America and the world. And so we do have bands and thresholds. We have rules. I mean, the most important thing maybe for those of you that actually have a plan that we're following, and most of our clients do, is that we have rules and they work and they've been tested. And I've spent thousands of hours making sure that the process and those rules are sensible and stand up well to historical bad states of time. So
on that note, actually, we had a question kind of on those lines. When you created our financial plan, you ran the portfolio through some bear market scenarios and the plan through some bear market scenarios. How does this current bear market compare to the ones that you tested against on the front end?
So, and you guys can stop me at any time, because there's 2 answers. The one the boys will give you, that is, they basically run it against a kind of a standard wash and rinse, broad stock market decline, where the broad stock market's maybe down 20-25%. And then we've always show in the investment policy statements or somewhere in the client communication what would happen to your plan if we walk into something like the Great Recession. From an historical perspective, about all we can say from this market decline, well, first of all, it's not what I consider, to date, it's not what I would consider, a bad situation when it comes to clients' plans. When we're doing simulations, and we do thousands of simulations, we have periods in there that are much worse than we've ever experienced historically. A lot of people are surprised to find out that if you're looking at a 30-year retirement and you look at historical periods for the last 100 years, the worst annual compounded return on a calendar basis was about 8.5% per year. That doesn't sound bad, but that one was the Great Depression when the stock market went down 85%. Well, we're nothing like that, and we have rules that try to compensate for even markets like that. So when we're doing simulations, all I can say is about 20% of our returns that we're simulating in outcomes are worse than we've ever experienced historically. That's arguably, that's overly pessimistic. But that's what we like to be really careful on the front end. And we've made some adjustments to our rules. In the last couple of years, we've kind of heightened the hurdle, from a stress testing standpoint to make sure that it's less likely that a client's going to have a modest spending cut. So from an historical perspective, I'd say that this is the quickest decline from all-time highs to a bear market for sure. But in the sense of magnitude, it's nowhere near anything what I would call bad yet. At this point, it's from a market decline standpoint. At the lows, the broad U.S. stock market was down about 36%. That's pretty close to the average bear market historically. So average stuff doesn't really rock a plan. We get into something that gets nasty, like a global depression, we're going to have some problems. But our rules, I've tested our rules against the global depression and what we would need to do, and I'm comforted that our rules will reduce potential problems. Look, there's no facts about the future. There's never any facts about the future. But if you have sensible rules like we do, we're not sitting around, just so clients know, we're not sitting around worried for our clients. And obviously that's because we're running the simulations, we're testing them historically to make sure that our process is sensible. But to a client, especially new clients, it's going to be pretty disturbing with all the accompanying talk and panic around.
Yeah, sort of on the that same note with new clients and clients who might be either thinking about retiring soon or have maybe recently retired. One of the questions we got is, what impact will the coronavirus have on someone who's planning to retire at the end of this year?
I'm going to pass that to you guys because I don't want to dominate all the talking here.
I have a couple new clients in that boat. I don't know if Daniel and Ryan do and want to chime in, but the answer so far, and part of this is because the market has rallied so much from where it dropped, but there's been minimal impact. So, and some of this gets back to the question of, do we need to stop our spending now? And the answer is usually no. And if there is any change in spending, it's relatively modest. And I think that surprises people sometimes when they see my portfolios, the stock portion's down, 35%. I feel like I need to turn my spending off or take this extreme measure. But when we're building plans and determining how much a client can spend or withdraw from their investment portfolio, we know declines like that are going to happen. We don't know when they're going to happen, and we don't know what the triggers will be, but we know that every several years or so, on average, a 30% decline or so happens in the stock market. So we build the plans to withstand those types of declines. And if we get relatively extreme ones, then there are some adjustments, but because we started so conservative, the adjustments, it's not like a one-to-one. It's not like my portfolio is down, 20%, so I need to cut my spending 20%. The spending decline or the withdrawal decline is going to be a much smaller magnitude than the actual portfolio decline. I think that just surprises people sometimes.
Yeah, the way I've been describing it to clients on the front end of our relationship is, look, if we think the heaviest car that's going to go across, if we were bridge builders and we were engineers and we had to build a bridge, and say, well, how strong are we going to make this thing? I'd say, well, it looks like the biggest car out there is 5,000 pounds. So let's make the bridge so, if a 10,000 pound truck goes over it, it's not going to collapse and it's still going to hold up. That's essentially the idea behind running it ahead of time and making sure that basically make the plan prove itself. Because as I said, there's no facts about the future, but I don't think anybody believes that there's not going to be continuous every 4 or 5 years we get treated to somewhere around a 30% decline in the broad stock market. That's kind of the essence. If we were bridge builders, we're going to build it for a lot heavier load. And that's why adjustments tend to be really modest. And they also tend to be temporary. So I always have to temper things by saying, look, again, there's no facts about the future. But historically, I've been doing this a long time and following these rules and this process for quite a long time. And I had a number of people that retired just before the 2008, 2009 Great Recession. And I had 4 or 5 clients out of a large number of clients that needed to reduce their spending maybe 5 to 10% for 4 or 5 months. It doesn't mean it couldn't be worse than that if we go into something even nastier.
Yeah, and for a specific example, I have one, sorry, Ryan, I have one client that I can specifically remember that had just come on, I mean, in February of 2020. So literally right before this, plans on retiring in mid this year. And I looked at their plan on the absolute worst day, and it still didn't require any adjustment to spending, but it was getting relatively close to our lower guardrail at that peak. And that's about what you would expect. We kind of, when my dad mentioned, you know, we revised some of our planning process and where we start, basically the way we built it was we wanted to get through a more normal bear market without requiring any adjustment to spending. And then if there's a really extreme one, like a great recession test, which you see in your financial plan, those are the types that require a spending cut. Well, this was somewhere kind of in between there. And that's why you were right on that border of potentially needing a modest adjustment, but then with the market rallying back up, they're nowhere near that point right now. So that's just for perspective, kind of a specific example.
Does anybody want to
And I think
yeah, I'm going to let you take this, Ryan, but you know, we do have these, what David just threw out a term that maybe you've heard us say or not, but guardrails. And we like to think about, there's a reason there's guardrails on the highway and on curves around mountains. Yeah, you may scratch up your car a bit and it may cost you a few dollars, but you don't go off the cliff. You guys kind of want to talk about those guardrails and the importance of those?
Can I add one thing real quick?
Sure.
To the last question? I would just urge anyone out there that's looking to retire and has outside accounts, so ones that aren't linked to Rudy Wealth already, feel free to update the new numbers of your 401ks or whatever you have. So we make sure the plan is up to date. So if you are planning on retiring, we love to get new information. So if we do need to make any changes, then we can tell you in advance.
Okay.
And that actually kind of dovetails on the comment that I was going to make a little bit earlier too, is that we're becoming a lot more aware of the sequence of return risk on the front end of retirement, which simply means that, as Paul has said endless times, you've probably never had more money in your life than you do right now, and you're about to pull the ripcord and go from a paycheck that's steady month after month to no longer getting a paycheck and now relying on your investments. We want to try to take some steps to potentially secure some of the money in the event that we go into your retirement and right on the front end, we go into a decline like we're going through right now. And so what we've done for a number of clients is, again, this can be prior to them becoming clients, but start talking to them about if we're 5 years out, if we're 2 years out, or 1 year out from that potential retirement date, that we have pared back their stock holdings potentially in their 401k or whatever their retirement plans may be, so that we're getting less fluctuation that might happen to them as they're about to pull that ripcord and go into retirement. And it's merely a hedging position because we and no one else has any clue what's going to happen in the markets today or tomorrow or in the future. But we have to be very wary of the possibility of someone hitting retire and then all of a sudden 30% of their assets that are held in stock positions could be reduced right on day one. So if you're not going into that retirement decision sitting at 60, 70, or 80% in stock holdings, and maybe you're down around 50 or 60, it takes a little bit of the fluctuation off the table for a client. And that's kind of been some of the strategy we've been implementing for a lot of our clients, just trying to bring down the fluctuation meter and also just the emotional turmoil that comes along with it as you're considering retiring. It's already a big decision and an emotional decision that helps kind of kill two birds with one stone. So,
Yeah, I'm gonna just briefly say one of the benefits. I mean, the boys would sometimes roll their eyes, I think, when they see me creating these gigantic computer simulation programs, and learning how to write code just so that I could go in and essentially audit our rules against every historical 30-year period in roughly the last 100 years. And I ran it over using rolling monthly data. It doesn't mean anything. It just says there's about 760 or 770 periods I got to test the rules through. And the maybe the biggest takeaway I gathered from that, and I think it's important, is really respect this idea that you can retire at just the wrong time. And by auditing it through some pretty horrible periods, it has taught us, and I think we've adopted that in the last year or two, of being much more conservative on the front end as far as how much in stocks versus how much of our portfolio in bonds. So there's some real value to not just creating rules, but how about going back and seeing if they actually work? I am so much more comforted now about our process after doing that. And again, I spent an incredible, it probably looked like an unproductive amount of time. But when you learn some big takeaways about your rules, I mean, as I told the boys, we don't have people's money in our hands. We have their lives in our hands. And they're relying on us and shifting the responsibility of maintaining their independence and dignity over a potentially 3-decade retirement. We owe it to the clients to make sure that we're auditing our rules and that. But so we did, and we've discussed them, the guys and I, some of the takeaways and adjustments to our rules. And I think they're for the better. And they're probably a little more conservative, and some people might say too conservative. But if we're going to be anything on the front end of retirement, that's what we're going to be.
So speaking of being on the front end of retirement, we actually just had a question roll through that I think is pretty specific to someone's situation, but they were wondering, we talk about time frames of retiring. If someone was to retire within 30 days and invest their money sometime within 30 to 60 days, I assume you maybe roll over a, company retirement account. Would you plan for that the same way you would plan for someone retiring at the end of the year? Or is there anything specific for someone in that short of a window of time that they need to be concerned about?
I'll let you guys take it, because you guys actually at this point run all the plans. So you're dealing with that question every day.
Yeah, it probably sounds weird, but I really wouldn't change anything, at least at this point. Like if the market pulls back to the absolute lows and we're close to that lower guardrail, I might have a conversation with the client and say, hey, technically we haven't crossed it, but if it makes you feel a little more comfortable and you want to start off a little more conservative with your spending, I don't hate that idea. But as things stand right now, I would say, look, we're going to start the plan exactly how we had created it from the get-go.
Would it be safe to say, David, that it would take something really drastic to make any meaningful change to a plan for someone who's contemplating whether it's 30 days from now, not much difference retiring 30 days from now to us and retiring a year from now? Would that be fair to say that 30 days or 1 year, we view that as the same thing?
Yeah, it makes, from a plan perspective, it makes basically no difference at all. It's just when you start thinking in dollar terms, it doesn't move the needle when you're looking at, for most of our clients that come on board, they're retiring around 60, mid 60s. We're looking at 20, 30 years, whether you start 6 months earlier and you have 29 and a half years or 30 years doesn't really move the needle too much.
Okay.
and that was going to be the point I was going to add in. So that's perfect. Is if you think of the equation kind of like a seesaw, where you're going up and down, with two people on one end, and you only have maybe like a couple months on this end, and you've got 30 years on this end, the 30 years is going to overweigh. So if you take an extra 6 or 11 distributions from your account this year versus waiting till next year, that 30 years is going to still essentially take care of the vast majority of how the plan is going to function and be good or bad. So that 1 year, whether it's 30 days or 1 year, is almost irrelevant. So I don't know if that's a good analogy or not.
Well, I think it is a good analogy, but I think to the person that's thinking about retiring in the next 12 months, times like these, you know, we talk about it, does it move the lever much or the needle much, which by that we mean it really doesn't change things. You almost can't even see a change. But you can understand why a client might think it probably has a major impact. If there's already a plan in place or a strategy in place, then we've already considered those really bad outcomes.
Yep. And I did have one client who voluntarily said, I'm just worried this is going to get a lot worse. It's going to be like the Great Recession. What would you tell me I could spend if that happened? Let's assume that it does, and I'm going to start my spending there. And I said, look, I don't think that's necessarily necessary because we could just make that adjustment if that happens. But if that makes you feel comfortable going into retirement and you are able to do everything you want to do with that level of income, that's fine. And that's what we're going to do. We're going to start them out. I basically modeled a portfolio decline equivalent to like the Great Recession and said, okay, well, if that happened, here's what you could spend. And we're starting out at that level. And then, you know, if it doesn't happen, we're going to ratchet him up. But if that's what gives him peace of mind, I don't think there's anything wrong with that. And maybe it's excessively conservative. You could poke holes in it, but it's, like I said, as long as you're doing everything you want to do for the most part, I don't see anything wrong with that.
And I think one of the things sort of related to this, but while I'm thinking about it, sometimes I think what gets missed is when stock markets decline 20, 30, or 40%, what's also going on at the same time is expected returns for the future are going up. And that tends to be somewhat of the counterbalance against the current decline. So in our mind, we see a 20 or 30% decline and we think we have trouble. On the other hand, in our view, and we get excited, and it is a counterbalance, is yes, but expected returns have kind of gone up substantially. And that tends to counteract the short-term damage over a 20 or 30-year retirement.
Well, speaking of things that can cause damage over a 20 or 30-year retirement, inflation. How do you guys like that transition? We've had a few questions on that. You know, yesterday, I guess we heard the first prediction of low 10s inflation. You have a lot of people worried about all these, stimulus programs that are sending a ton of money into the economy. How could that not cause inflation? How are we dealing with that? Do we have a plan for it? Is that incorporated in our plans? Who wants that one?
Well, I'm going to take it at first because I do a lot of thinking and reading about this. I've told a lot of clients or a number of clients, a lot of people have brought it up. It's naturally some of the things we're reading, and most of them are garbage. It naturally see them printing money, and they literally are printing money. And I have a little more detail about that. Well, I'm not scared about it. But the reason they're doing that, frankly, is the Federal Reserve's not sitting around worrying about inflation today. They're worried about deflation. Deflation is a real problem, and it's a lot nastier problem. And trust me, if I had to choose between reasonable inflation, not hyperinflation, and deflation, I'll take inflation all the time. Now, some of these policies are probably going to increase inflation somewhat. How much, nobody knows. I hope we have some inflation over the next 3 to 5 years, because that means we grew our way out of this problem and we didn't go into a depression. So that may sound weird, but 3 years from now, I hope inflation's 2 or 3 or 4%. Because if it's not, this rescue plan probably didn't work as well as they had hoped. Look, they're printing a lot of money, but doesn't necessarily mean has to go into inflation. There's not a lot of demand right now. So there's a lot of counterbalancing, but the real question was, do we have a strategy to deal with it if it comes up? That's the point. No, we can't predict, nor can anybody, that there's inflation. What I did when I tested our rules against actual historical data for basically 10 different stock bond mix allocations, okay? What I discovered is, and when I ran the rules using the historical data for returns, I also used the historical data for inflation. So we've had some periods, a lot of our clients can remember, any of us with the little bit of age and an adult memory. If you retired in 1966, you retired at a very terrible time. Over the next 30 years, your cost of living more than quadrupled. And returns in the first half of that retirement would have been basically zilch. So testing it through these historical audits, when I looked at the survival rate, which is essentially almost all of them survived or kept materially your standard of living that you wanted on the front end of retirement all through retirement. I was using actual inflation data. We had some real doozies. Some of you will remember, 16, 17, 18% mortgages. Inflation was 13%. CDs were 15 or 16%. And I audited our rules through those types of, and it did teach me something. So I'm not worried. I don't know if inflation is going to rear its ugly head. If it does, here's what I learned. Your investment in the great companies of America and the world are a pretty terrific hedge against it. Not perfectly over a short run period or any 3-year period, but over one's lifetime, those companies can increase their prices, increase dividends. And that's exactly what happened in the past high inflationary period. So I'm not too concerned about that, but it did tell me one thing. Some of the cure for an above trendline inflation rate, and in my historical auditing and testing, I said, look, if we're in an inflation zone, let me back up. Historically, over the last 100 years or so, inflation's averaged about 3% a year. What I found out is if it's over 4% a year for very long, you probably need to make sure you have to have 60 or 70% of your money invested in the great companies of America and the world, or is what my kids call it, the stock market. So two-pronged, I'm not particularly concerned about it. We could probably spend 3 hours talking about whether inflation is going to rear its ugly head. The Federal Reserve is more worried about deflation than inflation. I hope we get a little bit of inflation. That's a good sign. And whether we'll get way above trend line inflation, we'll have to see what comes. But we have strategies to attempt to counteract it.
Yeah, and one thing I'll just add too is like there's always going to be people making all kinds of different predictions, and the vast majority of economists that I've followed and heard from are not particularly concerned about high inflation. I was watching a webinar from Dimensional Fund Advisors. They had a guy, an economist named Ed Lazier, I think is how it's pronounced. And he was an economic advisor for George Bush, the second one. And he was saying that inflation becomes more of an issue when you have no slack in the economy. And he's like, right now we have a lot of slack, a lot of people not working that would like to work. And there's a lot of room for basically people to go back to work without wages increasing and things that are going to be inflationary. And he just basically said, look, he's not particularly concerned about it, especially in the short run. And essentially, it's kind of like, that's not our primary concern right now. And, you know, if it's a little higher in the future, yeah, maybe that happens. But you kind of have to have the stimulus, because like, what's the alternative, right? It's, okay, we don't do these things. Tons and tons of businesses go out of business because of this weird temporary shock that shouldn't have normally gone out of business. So I don't know. And then I know Fred Gertz on our radio show, he wasn't too concerned about it either. So I'm not saying it's not going to happen. I'm just saying balancing it out. It's not like it's a given that we're going to have high inflation because of this stimulus package.
Right. We heard the same things in 2008, 2009, because there was a
Yep.
$700 or $800 billion stimulus / rescue program then too. And of course, quantitative easing was maybe $4 trillion. A lot of what's going on when we start reading about these $2 and $3 and $4 trillion, a lot of that's just Federal Reserve keeping the credit markets going as they did in 2008, 2009. And any of you have been reading my newsletters for, since 2008, 2009, the world and the experts were on fire that we were going to have a market crash again. We were going to go into hyperinflation. Gold was the asset. I mean, month after month, year after year, that's what we were hearing. And I kept saying, what everybody missed is with all this quantitative easing, for the first time in the U.S. history, Federal Reserve paid interest on the reserves, excess reserves in the banking system. So everybody was thinking, oh, these trillions of dollars of excess reserves in the banking system is going to end up being too much money chasing too few goods, and we're going to have high inflation. I kept insisting that difference that the Fed was basically paying 0.25% interest when the banks could maybe get 0.1%. they all kept it at the Fed. It didn't find its way into the system. It was there more to prop up the credit markets because you have to have really well functioning credit markets in a country or you're in real trouble. And that's what they did this time too. They just did it faster and they did it with more money. So I think a lot of these people that are ringing the bells and the sirens for inflation are the same ones that did it 12 years ago. And we've had some of the lowest rates we've had nothing but disinflation and low interest rates. That leads me to think that when you pierce through what's really going on, we're not going to spend a lot of time worrying about inflation. We know clients naturally do when they read these articles. Be careful what you read. Turn CNBC off.
Well, and most importantly, like you said, is look if that happens, like our plans and when we're determining how much clients can spend, a lot of that's based on research that incorporated periods that had double-digit inflation. So you should, our planning process is designed to withstand high inflationary periods, just like it's designed to withstand periods of significant market declines.
And I think everybody needs to recognize, and we try to make this clear to clients, these plans are not the truth. These plans are just coming up with a sensible strategy in the face of uncertainty. So we have to practice rationality under uncertainty. So there's always a chance in any plan that, that standard of living you were really looking for and hoping for, there's always these small probabilities that life doesn't turn out quite the way we wanted it to. The important part is you don't want to end up in a disaster. And as long as you have rules, okay, so you don't get to go to Jamaica 6 months or 6 weeks a year. It's only 2 weeks a year. But you have to realize as clients, even with a really solid plan, there's going to be adjustments. Most of them are going to be to the upside, but occasionally you have to be prepared for adjustments in spending to the downside.
This is another thing kind of related to the stimulus package that I'll just answer real quick. But one of the questions was, how long will the bonus unemployment payments last? And just for a little background on that, as part of this stimulus package, the government expanded unemployment and actually raised the amount that you could get by $600. I think, is it per week?
Per week.
Per week. So a pretty big, if you think about that as over the course of a month, that's a pretty big jump. And that is actually set to expire July 31st as it is. And I just feel like the question behind that question is, will people have an incentive to get back to work before that happens? And the answer is not as much of an incentive. No. I was reading actually an article on, I hate to say it, Dad, but CNBC about, about this lady who basically went out and got a triple P loan in order to be able to keep her employees, and they were mad at her.
Triple P, yeah.
Paycheck protection program. I know it's all jargon to people anyway you slice it. But moral of the story, she was going to go out and get a stimulus loan to be able to keep her employees, and they were upset because they were about to get a windfall from unemployment. And I guess the number now with that new $600 payment, you have to make like $24 an hour to be better off than just collecting unemployment and government assistance. So I mean, the bar is just that much higher. So I would expect unemployment. I mean, I'm not an economist, but I can't imagine, it will go up a ton until that ends.
Well, let's see, we could go be a server in a restaurant and maybe make 10, 12, 15 bucks an hour and work hard. Or, hey, I'll tell you what, you know what they're going to say? Check back on August 1st. And then we might be interested in coming to work. So there's some of these moral hazards we've put in there. A lot of reaction, as you might imagine, politicians making some pretty incredible decisions shortly, over a short period of time. So there's always going to be some bad parts of any of these policies.
Yeah, and also kind of on the economic note, and I really wish we had Dr. Fred here to answer this one, but Dad, maybe you can take it. Where does the Illinois government stand regarding its deficits? Do you expect a federal bailout? And, are they looking at bankruptcy potentially?
Well, I mean, maybe to all of those questions. Obviously, a state that's in one of the worst financial conditions before this can only make things worse. They've asked for a bailout. It's been kind of rebuked. A lot of the states that have kind of gotten their stuff together over the years aren't excited about bailing out Illinois. Whether they should or shouldn't, I'm going to stay apolitical on that. Look, these are the same people that said, "Oh, we really don't have anything to worry about yet." They run and ask for $40 billion in aid from the government. So, is the federal government going to do that? I don't know. Are they going to give them maybe a few billion a year if they sort of clean up their act over the next few years? I don't know. And then as far as bankruptcy, it's interesting. Mitch McConnell kind of let up the trial balloon that maybe will let states, and the U.S. could do that. They could suddenly let states go bankrupt. But whether that's going to happen, I think if Fred was here, I don't want to speak for Fred. I'm just guessing. I'm talking about Dr. Fred Gertz. Is to date, at least, I haven't asked him since then. He felt like, this is a big issue, but we don't know if it's 40 or 50 years from now when the state kind of has to really deal with things. Maybe a question under the question is a lot of our clients have a pension that's coming from the state university's retirement system, and they have, they have the 3% cost of living adjustment, and they've tried to make some modifications in the state constitution, but by law they're prohibited. So it would take the U.S. government action to allow states to go bankrupt, and that doesn't mean they would, but it certainly gives them the ability to mess with the pension payouts.
I think Dr. Fred would approve of that answer. Well, hey, we're coming up on about an hour now. That's how much we originally had this scheduled for, and we are kind of back to our very last question, or kind of series of questions. That's about tax loss harvesting. First of all, what does that even mean? How does it benefit a client? Because that's one of the ways that we actually are kind of active during a stock decline.
Sure. I can start if people just want to chime in, if that works.
Go ahead.
Tax loss harvesting is really just a tax arbitrage strategy that says if your individual holdings that you have in a taxable account, so again, an account that's not in an IRA, that's tax privileged and delayed on taxes, not a 401k, but a taxable account is currently in a loss position, you have the ability to sell that position at a loss and immediately at the same time buy another similar yet not substantially identical security or holding. And then at the end of a 30-day waiting period, you can then essentially reverse that trade as long as there's not substantial gains built up, and book the amount of loss that you had lost on that initial holding for the grand purpose of reducing your taxable gains and any gains for that year. Or if there are not taxable gains in the year, it can reduce up to $3,000 of income in that year. And any amount, for example, if you had a $10,000 loss this year and there were no gains, you could book $3,000 against your income for the year. And that remainder of that 10,000 would be 7,000 carried forward. And you could continue to use that amount year after year until it's used up. So it is a strategy not for any other purpose other than for a tax arbitrage, trying to give you an ability to stay invested in the market while at the same time getting essentially a tax write-off.
And Daniel, I know through we have the co-pilot, which you head up, which are people with smaller accounts, younger folks. They're doing they have an automated tax loss harvesting, don't they, through Betterment?
Correct. Really nice.
Yeah, and they've been pretty active. And David, is the benefit, I mean, you read a lot of articles that really tout tax loss harvesting as if it's some major deal. Is this a major thing or a marginal benefit?
I would say it's marginal, and the amount of benefit depends somewhat on your tax bracket. The higher tax bracket you're in, the more benefit there's going to be. I think really where the most benefit comes from is that offset of the ordinary income of a few $1,000s per year, because capital gains are normally taxed at preferential tax rates, 0% up to the basically where the 12% ordinary income bracket starts. But ordinary income brackets are a lot higher. So like, especially for people who might be in, the 22, 24, the higher tax brackets all the way up to 30. Now, all of a sudden, you're getting to offset, basically take a tax deduction at that higher marginal tax rate. So it can help, but most of it is just kind of deferring taxes down the road, which there's a benefit to.
And Paul, there's one thing, I'm going to be brief if you can believe it, but when I'm getting a lot of questions with all this rescue bailout plan, how are we going to pay for this? And I put together a number of charts And I'm going to share my screen, and again, I'll be brief, and you guys can just tell me to if I can get my cursor here. So some of you might want to stay on and see this. I'm going to share that. So I'm sharing my iPad here. I'm going to shrink you guys down so I can see my chart. So how are we going to pay for this is kind of the question. And fortunately, like a lot of things, we could go back to World War II and see the impact on the next 75 years. So this first chart is basically a federal government tax receipts and spending. But what I'm going to highlight is when we get into the wartime era down here, you can see our deficit, our outlays compared to what we were bringing in here. So we had very similar type situation in the war there. So we've sort of been through this before. And here's another view of those deficits. So in 1943, 30% was kind of the highlight. And we're probably looking at something like that coming up. But my point is we've been there before. So this is the federal budget deficit as a percent of GDP. And that's kind of a meaningful picture. If we look at government debt as a share of GDP, it rose sixfold, kind of starting in 1943. That's kind of what we're looking at now. Maybe even a little more. We may beat this record of wartime. So I'm just building a case that this isn't unprecedented. And I think what I'm going to show you is it doesn't have to become a big problem. It's something a lot of people don't understand, because when we think of owing debt and taking on more debt, we tend to think about it as individuals. If we take out a mortgage in 30 years or 15 years, they want to be paid back. The US and countries, they don't have an ending date. So they can let debt build and build and build, which sounds horrible, but it's really how you deal with that. And how is that debt ever going to get paid off? Well, it doesn't get paid off. You don't pay. Let me go to my highlighter here. I can't. So at the top, it says you don't pay it off. We have to grow our way out of it. And it's paid off in the sense that the economy grew faster than the debt. So if we fast forward from 1945, here's that line of the debt. How much debt do we have compared to the size of the output of the United States? And you can see that by 1980 or so, we pretty much took care of that problem. And we did it in two ways. As I wrote at the bottom there, without repaying a cent of the debt, the burden could easily be less in another generation than it is today. And it kind of messes with our minds of how can that be? Because look at these big deficits here, but yet when we look at what really counts, this line, it hasn't become a problem. And we look at federal interest rate payments. Yeah, they were high. This is that inflationary period of the 80s. But our interest on the federal debt, and I know some of you are going to say, yeah, but that's because we're at low interest rates. It kind of makes things better. If the Treasury and the government's going to overspend and borrow a lot of money, you might as well do that at epic low long-term and short-term interest rates. But we're back to where we were sort of back in the wartime. That's just kind of my way of saying is, look, we've been through this before. The way they dealt with it is they raised taxes after the war and during the war, and basically inflation had its turn on it, and that reduced some of this burden. But mostly we grew our way out of it. In other words, as long as nominal GDP, the before inflation effect of what the country produces, as long as on an annual basis it grows faster than the extra debt that you're taking on, the problem essentially begins to go away and becomes not that big of a problem. So that leads me to think, my best guess, we're going to have a lot higher taxes in the future like we did during and after the war. Spending will begin to be reduced, but not as much as people hope for. And that's probably never going to actually decline. It's probably going to increase every year. I just don't think it's the end of the world. And you're going to read a lot of stories and see a lot of pundits telling you how horrible this is and what we're doing to our. I'm not proud of it. I'm not saying it's a good idea. I'm just saying there is a mechanism for growing your way out of it. Increasing taxes some. I'm not promoting the idea, but I think it's coming. that obviously dampens growth. So there's a pretty good lesson here from an historical basis that I'm not overly concerned about. I'm not happy about it, but I'm not overly concerned in thinking about my grandchildren that I have, that somehow we're putting a burden on them. I don't think it's a great idea to constantly have big deficits, but they're going to be what they're going to be. The question is, for us as investors and retirees, is it going to have any really horrible impact on us? And at least from an historical perspective, the answer is probably no. I'm going to stop my share and hand it back to you, Paul.
Good deal. I think that is actually all we have. We made it through all the live questions and all the questions we got in advance. So I just wanted to thank everyone for being here. You know, this is our first time doing something like this. So maybe we, you know, had some amateur stuff interrupting each other, but we'll work on that. Fortunately, my internet didn't cut out. That was a bonus because I'm here on the home internet, and that was a little bit of a risk. But yeah, once again, thanks for being here. You guys were kind of our guinea pigs. So please let us know, give us feedback on whether you enjoyed it, whether you didn't like it. You know, we want to hear whatever you have to say. So, I think we might have one. Oh, that's actually just says, thank you guys is our last question. Well, thank you guys for being here, and we'll go ahead and sign off.
All right. Goodbye, everybody. Thanks for listening.